Money. It's not just about numbers, salaries, or bank accounts. It's about how we think, how we feel, and how we make decisions every single day. The Psychology of Money by Morgan Housel reveals a powerful truth. Financial success isn't driven by intelligence, it's driven by behavior. In this podcast, we'll uncover why some people with modest incomes quietly build wealth, while others with high salaries struggle to stay afloat. If you've ever wondered what truly shapes our relationship with money, stay with us, because this episode might just change the way you think about wealth forever. Let's start it.
Well, really matter.
Glad to be here.
So today, we're tackling something pretty fundamental. What if getting good with money isn't really about how smart you are?
Right. What if it's much more about, how you act, your behavior?
Exactly. This deep dive is all about the psychology of money. We're talking soft skills, the stuff that often counts way more than the spreadsheets or the complex financial theory.
And we've really dug into Morgan Housel's book, The Psychology of Money. It's just packed with fascinating stories and insights on this.
It really is. And our mission really is to pull off those surprising truths about why we do what we do with money. Because understanding your own human nature, that might just be your biggest financial edge.
Absolutely. We want to help you think a bit differently about your own journey with money.
Okay, so to kick things off, let's paint a picture with two really different stories.
Okay, story one. Picture this tech executive in LA. A total genius, right? Designed Wi-Fi components in his 20s, started and sold companies. You assume financially he's got it all figured out.
You totally would. But his relationship with money was, well, strange. He'd carry these thick stacks of $100 bills, bricks of cash.
And flash them around. Apparently, he once got a colleague to buy thousands in gold coins.
Just to skip them across the Pacific Ocean, like rocks.
Yeah, just for fun, he supposedly said.
Wow. Okay.
And then, days later, he absolutely loses it at a hotel manager over a broken lamp. A $500 lamp.
So this guy?
The same guy throws $5,000 cash at the manager, tells him to get lost and never insult him again. Yeah.
And the ending isn't surprising, is it?
Sadly, no. Years later, bankrupt. Completely broke.
Okay, hold that image. Now let's switch gears completely. Ronald Reed.
Ah, yes, Ronald Reed, the Vermont janitor.
His Wikipedia entry literally says, American philanthropist, investor, janitor, and gas station attendant. First in his family to finish high school. Hitchhiked to get there.
Lived a really simple, humble life. Fixed cars for 25 years, swept floors at JCPenney for 17.
Bought a small house for $12,000, lived there his whole life.
And then he dies in 2014, age 92. And suddenly, this quiet guy is making international news.
Because Ronald Reed, the humble janitor,
Yeah.
left behind over $8 million.
$8 million.
Yeah.
Gave $2 million to his stepkids, $6 million to the local hospital and library. People were just stunned. How?
Right. No big inheritance.
No, nothing like that.
Yeah.
The secret was incredibly mundane. He saved what little he could.
Just consistently saved.
Put it into blue chip stocks, solid big companies.
And then he just waited.
Decades. Just waited. Let those small savings compound and compound.
Yeah.
To $8 million.
So you put those two lives side by side, the tech genius and the janitor,
It's crystal clear, isn't it?
doing well with money. It really isn't about raw intelligence. It's about behavior. That's the psychology of money right there.
Absolutely. Ronald Reed mastered the simple stuff, the behavior, and look what happened.
That really drives it home. And that behavioral side leads to another really key idea from the book. Financially speaking, no one's crazy.
Right. That sounds counterintuitive, but think about it.
Okay, explain that. Because some decisions look crazy from the outside.
They do. But Housel's point is that every decision makes sense to the person making it at that specific moment. It's shaped entirely by their unique life experiences, their personal history with money.
Okay. So it's all about their individual perspective. Different generations, different economic backgrounds. They learn totally different lessons.
Exactly. Your own experiences, even though they're statistically insignificant on a global scale.
Like 0.000000001% of what's happened.
Right. They still shape maybe 80% of how you think the world works. It's wild.
Wow. So personal experience massively outweighs textbook knowledge.
Think about the Great Depression. JFK, coming from immense wealth, his family actually did well then. He learned about it by reading books at Harvard.
Compared to millions who lived through it who were scarred by it.
For them, it wasn't history. It was a visceral lesson that shaped everything. Some lessons you just have to live through them to really get them.
And there's actual economic research backing this up.
Yeah, Ulrich Malmendier and Stefan Nagel, they found people's investment choices over their whole lives are heavily influenced by what happened early in their adult life.
So if you experienced high inflation young,
You're probably going to invest less in bonds later on, even if logically bonds seem like a good idea at that point. It's not about smarts, it's just the luck of when and where you grew up.
that's fascinating. It challenges so many assumptions.
It even challenges how we view things like, say, factory work in other countries. There's this story about a Foxconn worker.
The place is often called sweatshops here.
Exactly. But this worker's nephew pointed out that for his aunt, working there was a huge step up from her previous life, which was prostitution.
Whoa. Okay.
Her options, her reality were just completely different from what a typical American might assume. It forces you to question what exploitation or opportunity even means in different contexts.
That really makes you pause. And it connects to something like why lower income people might buy more lottery tickets, right? Which financially seems illogical to many.
From the outside, maybe, but Housel argues they're buying a dream, a tangible hope of getting the kind of life and security that maybe, wealthier people already have and take for granted.
So you might not understand paying for that dream because you're already living some version of it.
Exactly. It's not strictly rational, perhaps, but it's perfectly reasonable given their circumstances and perspective.
Okay, so big takeaway here is empathy, maybe,
Mm.
and recognizing our own biases shaped by our limited experience.
Definitely. And understanding that means recognizing how much is outside our direct control, which leads us straight into luck and risk.
Ah, yes, the dynamic duo. We like to focus on skill, but luck.
Luck plays a massive role. Take Bill Gates, obviously brilliant, driven, but the luck involved. Attending Lakeside School in 1968.
The one with a super advanced computer when almost no one else had that kind of access?
Right. 1 in a million chance, globally speaking, for a high school kid back then. Amazing luck.
But then there's the flip side, Ken Evans.
Ken Evans, Gates' friend, Paul Allen's partner, just as smart, just as ambitious by all accounts.
But he died young in a mountaineering accident. Never got to see Microsoft take off.
It's a sobering reminder. For every huge success like Gates, there's potentially a Ken Evans whose story we never hear because luck, or rather bad luck, intervened. Risk.
It makes judging success and failure so difficult, doesn't it?
Totally. We tend to blame others' failures on bad choices, but excuse our own as just, bad luck or risk. It's hard to untangle skill from fortune.
And we learn the wrong lessons because of it.
Think about historical figures. Vanderbilt, Rockefeller, praised now for their bold genius.
But they bent or broke laws constantly. Right?
Absolutely. Vanderbilt basically said, law? Who cares? I have the power. And it worked out for him. But that line between bold visionary and reckless criminal is paper thin.
It's only clear in hindsight because they succeeded. It could have easily gone the other way. Ruin instead of riches.
Exactly. Risk and luck. Robert Shiller, the Nobel economist, said the one thing he wishes he could know about investing but can't is the exact role luck plays.
Because it's impossible to measure, but it's always there.
Always. Two sides of the same coin. And ignoring that leads to maybe the most dangerous psychological trap in money.
Which it's...
Never having enough. The moving goalposts.
Ah, yes. This one's insidious. You see it with people who already have so much.
Like Rajat Gupta. Hugely successful executive, board seats millions, throws it away for $17 million more through insider trading.
Yeah.
Or Bernie Madoff. Already incredibly wealthy, runs a massive Ponzi scheme. Why?
Just more.
Just more. Or long-term capital management, the hedge fund full of Nobel laureates and Wall Street legends, multimillionaires.
They blew up spectacularly in '98.
Blew up completely, took insane risks, chasing even more money they didn't need, risking everything they did need.
Buffett's quote on that is perfect.
Yeah. To make money they didn't have and didn't need, they risked what they did have and did need. And that's foolish. It is just plain foolish.
Because if your expectations just keep rising with your income or net worth,
You never feel satisfied. You always feel like you're falling behind, which pushes you to take bigger risks.
it's that social comparison thing. Like
Yeah.
the rookie baseball player making $500K feeling poor next to Mike Trout's $430 million deal.
Exactly. You can't win the comparison game. There's always someone richer. The only way to win is just don't play, opt out.
Which means recognizing what's actually important, what you should never risk.
Your reputation, your freedom, independence, family, friends, happiness. These things are invaluable.
And knowing when you have enough is the only way to protect them. Because that hunger for just one more dollar can eventually cost you everything that matters.
Well said. And knowing enough ties into another concept that seems simple but is incredibly powerful: compounding.
Ah, compounding. The eighth wonder of the world, supposedly. But it's hard to really feel its power, isn't it?
It is. The book uses a great analogy: ice ages.
How do ice ages connect to money?
Well, ice ages don't happen because of brutally cold winters. They happen because summers are just cool enough that the previous winter's snow doesn't entirely melt.
So a little bit stays.
A little bit stays, then more snow falls, a little bit of that stays, layer upon layer, year after year. Small, consistent accumulation leads to miles-thick ice sheets. Exponential growth from tiny, persistent gains.
That's a fantastic way to visualize it. And that's Buffett's real magic.
His skill is investing, no doubt, but his secret weapon is time. Just look at the numbers. 99.9% of his wealth came after age 50.
Wow, 99.9%. So if he'd been like a normal, successful investor, started in his 30s, retired in his 60s.
We probably wouldn't know his name. He'd have maybe $12 million, not 80-something billion. It's all about that incredible runway of time.
Compare him to Jim Simons, the quant genius.
Simon's firm, Renaissance Technologies, has averaged like 66% annual return since '88. Insane numbers. 3 times Buffett's rate.
But Simons is worth significantly less than Buffett.
Because he only really hit his stride around age 50, he's had less than half the time for that compounding to work its magic. Even with much higher returns, time wins.
It really shows how our brains just aren't built for exponential thinking. Small differences over long periods become
Ridiculous numbers. Like hard drive storage, megabytes to terabytes. It's mind-boggling growth, hard to predict looking forward.
So the best investment advice might just be,
Shut up and wait. It's not about chasing the absolute highest returns, because those are often fleeting.
it's about getting good, solid returns you can stick with.
For the longest possible time, that's where the real wealth generation happens.
Which brings up a really important point. Getting wealthy versus staying wealthy.
Totally different skill sets. Crucial distinction.
Okay, illustrate that. The book uses Jesse Livermore, right? The legendary trader.
Livermore made a fortune equivalent to billions today, shorting the 1929 crash. Genius timing. At the same time, another guy, Abraham Jermansky, a millionaire developer, lost everything in that same crash and just vanished.
A stark contrast. But Livermore's story didn't end well either.
Nope. He got overconfident after 29, made bigger and bigger bets, took on huge debt, and eventually lost it all. Die broke.
So getting rich often involves taking big risks, being optimistic, maybe even aggressive.
But staying rich, that requires the opposite. Frugality, caution, maybe even a degree of paranoia. Survival.
Michael Moritz from Sequoia Capital said their success is just about longevity, right? Outlasting others.
Exactly. Survival is the key. Look at Buffett again. It's not just the stocks he picked, it's what he didn't do.
Didn't get over-leveraged with debt.
Didn't panic selling crashes.
Didn't ruin his reputation.
Didn't get stuck on one strategy, didn't burn out. He survived. And survival lets compounding do its thing.
And then there was the third guy in the early Buffett-Munger partnership, Rick Guerin.
Rick Guerin, just as smart as Buffett and Munger apparently, but he was in a hurry.
Used margin loans. Borrowed against his stock.
Yep. And when the market tanked in 73, 74, he got margin calls. Forced to sell his Berkshire Hathaway stock at the bottom to cover his debts. Wiped out.
Well, Buffett and Munger held on.
They had the added crucial skill of staying wealthy. Being financially unbreakable is more important than aiming for the absolute highest returns.
Because being unbreakable means you can stick around for the long haul. You avoid that one catastrophic mistake, that forced sale at the worst possible time.
You need cash, that buffer, even if it earns nothing. Its real return is preventing ruin.
And planning needs to account for, well, chaos.
Totally. The most important part of any plan is to plan for the plan not going according to plan. 9/11, financial crises, pandemics, nobody predicts these things accurately.
So you need that margin of safety.
You need that barbelled personality Housel talks about. Optimistic about the long-term future, but paranoid about the short-term obstacles that could stop you from getting there.
Like looking at U.S. history. Incredible long-term growth despite wars, depressions, pandemics, constant crises.
Growth happens alongside misery. You need optimism and paranoia to navigate it.
And that unpredictability, those unexpected events, that leads to the next idea. Tails, you win.
Right. This is huge. It means that most of the results in investing, in business, and many parts of life come from a tiny number of outlier events, the tails of the distribution curve.
Like the art collector Heinz Berggruen. He amassed this incredible collection worth maybe €1 billion. How'd he pick winners?
He didn't really pick winners so much as buy everything. He bought vast amounts of art. Most of it was probably mediocre, but a small subset turned out to be masterpieces.
So he was like an index fund for art.
Basically, he bought broadly and held on long enough for the huge winners, the tails, to dominate the portfolio's overall return.
You see this everywhere. Walt Disney.
Made hundreds of cartoons, most lost money or broke even. Then came Snow White, 83 minutes.
And it changed everything. Earned a fortune, funded the company's future, a classic tale event.
And we mostly pay attention only to these massive successes, these tales. So we underestimate how rare they are and how much failure surrounds them.
Venture capital is built entirely on this, right? Expect most startups to fail, hope for one or two massive home runs.
Exactly. And even in the public stock market, JP Morgan found 40% of stocks effectively die, lose most of their value, and never recover. All the index gains came from just 7% of the companies.
Even successful companies can have catastrophic failures. Like Carolco, the studio behind Terminator 2. Huge hit, but they still went bankrupt later.
It means for an investor, being average most of the time is fine. The real genius is the man who can do the average thing when all those around him are going crazy.
It's how you handle the panic, the downturns, those moments of terror.
That determines your long-term success, which is why embracing failure is so important.
Like Jeff Bezos after the Fire phone flopped.
Saying we're working on much bigger failures right now. Or Reed Hastings at Netflix wanting a lower hit ratio, meaning they need to take more risks.
Or Chris Rock testing hundreds of jokes in small clubs.
Knowing most will bomb. The polished Netflix special is just the successful tale. Even Buffett. Most of his wealth came from maybe 10 stocks out of the 400, 500 he's owned.
Munger said without Berkshire's top few investments, their record is just pretty average.
You can be wrong, even mostly wrong, and still end up incredibly successful if your few wins are big enough. It's all about the tails.
Okay, so if tails drive returns and look is huge and behavior is key, what's the ultimate goal or benefit of wealth?
This leads to maybe my favorite point in the book. Freedom. The highest form of wealth is freedom.
Tell me more. That resonates.
It's about control over your life. The ability to do what you want, when you want, with whom you want, for as long as you want. That, Housel argues, is the highest dividend money pays. It's priceless.
There's psychological research on this?
Yeah, Angus Campbell at the University of Michigan found that having a strong sense of control over your life is a better predictor of happiness than your salary, your house size, job title, any of that.
Wow. Control is key.
And even a little bit of wealth buys you some control, some freedom, taking a sick day without worry, having time to find the right job after a layoff, not just the first one.
Having a few months of emergency savings means your boss doesn't own you.
Absolutely. Your own experience in banking kind of illustrates this, right?
Totally. I chased the money, got the fancy internship, loved the actual work, the analysis, but the hours, the complete lack of control over my own time.
It crushed the enjoyment.
Completely. Doing something you love, but on someone else's brutal schedule, it felt the same as doing work I hated. I quit after a month. That control was just non-negotiable for me, I realized.
It's like Derek Sivers' story. Felt truly rich when he'd saved just $12,000 at age 22.
Because it let him quit his day job and be a full-time musician.
Exactly. Gave him control over his time. He said selling his company later for millions didn't actually change his happiness level nearly as much as that initial $12K freedom fund did.
It explains that paradox in America, doesn't it? Richest nation ever, but not necessarily happier than in the 50s.
We used the wealth to buy more stuff, bigger houses, but maybe traded away control over our time to get it. Longer commutes, more pressure.
And when you ask older people what they value most,
Like Carl Pillimer did, interviewing 1,000 elders. They don't talk about money or career achievements. They talk about quality friendships, being part of something meaningful.
and time with their kids, unstructured time.
They said their kids didn't want their money nearly as much as they just wanted them. Their time, their presence, powerful stuff.
Really powerful. Okay, speaking of what people want and what they see, let's talk about the man in the car paradox.
Ah, yes. And the idea that wealth is what you don't see.
Explain the paradox first. It's quite clever.
So you see someone driving a fancy car, say a Ferrari, you might think, wow, cool car. You might even admire it.
Right.
The paradox is you admire the car. You rarely think, wow, the driver of that car is so cool. Instead, you use the car as a benchmark for your own desire. You think, wow, if I had that car, people would think I'm cool.
So the driver thinks their car is getting them admiration, but the observer is just projecting their own desires onto the car.
Pretty much. People want wealth to signal admiration, but others rarely grant them that admiration directly. They just see the wealth as something they want.
That reminds me of the story about Roger, the guy with the Porsche.
The valet's story. Yeah, everyone sees Roger in his Porsche, assumes he's loaded, then one day he shows up in an old Honda.
Porsche got repossessed. He defaulted on the loan.
Exactly. The fancy car wasn't a sign of wealth, it was a sign of debt, or at least money spent. All you know for sure when you see someone in a $100,000 car is that they have $100,000 less cash, or $100,000 more debt than before they bought it.
Which leads directly to wealth is what you don't see.
Precisely. Wealth isn't the car, the diamonds, the fancy clothes. It's the income not spent. It's the assets accumulating quietly in accounts. It's money that hasn't been converted into visible stuff yet.
It's like Rihanna's financial advisor tried to tell her.
Was it really necessary to tell her that if you spend money on things, you will end up with the things and not the money? It sounds blindingly obvious.
But it's profound. The only way to be wealthy is to not spend the money you have. Wanting to be a millionaire is the opposite of wanting to spend $1 million.
Rich is visible income. Wealth is hidden. It's the income not spent, giving you options, flexibility, freedom.
The diet and exercise analogy helps here too.
Right. Exercise is like being rich. It's the visible action. Wealth is like turning down the dessert. It's the restraint, the thing you don't do that creates the long-term benefit, the gap.
That gap is everything, which is why the next point is so fundamental, even if it sounds basic. Save money, just save.
It seems obvious, but it's worth hammering home. First off, saving is the part you control completely. Investment returns, unpredictable. Economy, who knows? But your savings rate, that's largely up to you.
It's like energy efficiency for your finances, more controllable than finding new energy sources.
Great analogy. And if your lifestyle inflates just as fast as your income or investments grow, you're not actually getting wealthier in terms of freedom or security.
You need that gap. Learning to be happy with less creates that gap.
And think about the insane effort that goes into chasing an extra 0.5% investment return when maybe you could find 2-3% just by trimming lifestyle bloat. It's often easier fruit to pick.
Ego plays a big role here too, doesn't it?
Hugely. Past a certain level of income, what you need is just what sits below your ego. Spending to show off is the enemy of saving. Humility builds wealth.
But the biggest return on savings isn't even financial, is it?
It's flexibility. Saving without a specific goal, just saving for saving's sake, buys you options, time to think, ability to wait for opportunities, resilience against surprises.
That unseen return of flexibility and independence. In today's world, that's maybe the most valuable thing money can buy.
Absolutely. Control over your time, bought by savings, is becoming a critical currency.
Okay, so we're saving, we understand wealth is hidden. How should we actually make financial decisions? This brings us to being reasonable versus purely rational.
Yes, this is a really practical, important insight. We aren't spreadsheets, we're humans. Emotional, messy, wonderful humans.
So aiming for cold, hard rationality
Yeah.
maybe isn't the best goal.
Probably not, because it's unrealistic for most of us. The goal should be to be pretty reasonable, because reasonable is achievable, and more importantly, it's sustainable. You can stick with reasonable long term.
The book's analogy here is wild. The syphilis cure.
Julius Wagner Jauregg won a Nobel Prize for infecting syphilis patients with malaria. The high fever sometimes killed the syphilis bacteria. Scientifically rational in a way.
But unbelievably brutal and dangerous.
Exactly. Today, we treat a fever with Tylenol. Is it perfectly rational to suppress the body's natural defense? Maybe not. But it's reasonable because people don't want to suffer. We optimize for comfort and sleep, not pure logic.
And that applies to investing.
Directly. Harry Markowitz, the father of modern portfolio theory, won a Nobel for mathematically optimizing risk and return. But how did he invest his own retirement money?
50-50 stocks and bonds, right? Not the optimal portfolio.
Right, he did it to minimize future regret. He wanted to sleep at night. He was being reasonable, not purely rational according to his own theories. Investing isn't just math, it's emotional.
Like those academic papers suggesting young people use 2-to-1 leverage. Borrow money to double down on stocks.
Mathematically rational on paper, maybe maximizes expected long-term returns. But imagine getting wiped out in a 50% crash. Could you emotionally stick with that strategy?
No way. It's absurdly unreasonable for a real person.
So sometimes a strategy that isn't perfectly optimal on paper might be better if you can actually stick with it. If you love the companies you invest in, maybe you'll hold on through tough times. That commitment is valuable.
So even things that look like biases, like investing mostly in your home country.
Or even doing a tiny bit of speculative trading on the side if it scratches an itch and stops you from messing with your main long-term portfolio.
Those could actually be reasonable choices.
They can be, if they help you stay the course with the important stuff. Like Jack Bogle investing in his son's high-fee fund. Was it financially optimal? No. Was it reasonable for family harmony? Yes. Life isn't always consistent.
That makes so much sense. Be reasonable, stick with it. Which leads us to accepting surprise.
Exactly. The world is inherently unpredictable. Things happen that have never happened before, all the time.
History is a guide, but not a perfect map for the future.
Especially in finance. As Richard Feynman said, physics would be way harder if electrons had feelings. Well, guess what? Investors have feelings. That makes predicting their behavior based purely on the past incredibly difficult.
You can trace crazy chains of events, like 9/11 leading indirectly to changes in interest rates, which fueled the housing bubble, which led to the financial crisis. These unpredictable tail events connect everything.
So the lesson from surprises, as Daniel Kahneman says, isn't don't make that mistake again. It's simply the world is surprising.
We need to expect the unexpected.
And recognize that history can be misleading because the underlying structure changes. 401k, Roth IRAs, venture capital, index funds. These things fundamentally change the investing landscape.
Even the frequency of recessions has changed. Old formulas don't always apply because the game itself is different.
Benjamin Graham was a genius, but his specific methods became outdated because things changed.
So if the world is surprising and unpredictable, how do we possibly navigate it?
With room for error, margin of safety, redundancy, whatever you call it.
This seems critical, like the blackjack card counters.
Yeah. Even with the statistical edge, they need a big bankroll, a margin of safety to survive streaks of bad luck. They know they'll lose sometimes, even with an edge. They plan on the plan not going perfectly.
So margin safety isn't just being conservative. It's what allows you to endure long enough for the odds to eventually work in your favor.
Exactly. It lets you survive the inevitable downturns and stick around for the eventual recovery and growth. It makes precise forecasting less necessary.
Bill Gates keeping a year's payroll in the bank at early Microsoft.
Buffett refusing to risk a night's sleep for extra profit. It's about building buffers.
And it's not just financial room for error, but emotional too, right?
Definitely. A 30% drop might be survivable on paper, but can you emotionally handle seeing your life savings shrink like that without panicking? That gap between financial capacity and emotional tolerance is a key margin of safety.
So when planning for retirement, maybe assume lower future returns than the historical average.
That's a common way to build in margin. Just assume things won't be quite as good as they were in the past. And avoid leverage like the plague. Debt removes your margin for error. It turns normal volatility into potential ruin.
This story about the mice disabling German tanks in WWII.
Astonishing, right? They ate the wiring. You can plan for enemy attacks, breakdowns, but mice, you can't plan for everything, especially the crazy stuff.
So you need buffers against the things you can't even imagine.
Which means avoiding single points of failure. Anything that can break will eventually break. Have backups.
And the biggest financial single point of failure for most people.
Relying solely on a paycheck with no savings, that's why saving without a specific goal is so vital. It's your buffer against the truly unforeseen.
Okay, so we're building in room for error because the world is surprising. But there's another layer of unpredictability. You'll change.
Oh, this one's huge. The end of history illusion. We're terrible at predicting how much our future selves will change our goals, our desires, what makes us happy.
Like how few college grads end up in jobs related to their major. Our plans change.
Massively. So making rigid, decades-long financial plans is really hard because the you who made the plan might be a totally different person from the you living with the consequences 30 years later.
Daniel Gilbert's point about making decisions that our future selves might not be thrilled with.
It's so true. We're constantly setting things up for a future person who might want something completely different.
So what's the solution? How do you plan for a future self you don't know yet?
Avoid extremes. Don't lock yourself into a plan that requires, say, living on an extremely low income forever, or working 100 hours a week until you're 65.
Because the appeal of those extremes might fade, but the downsides could become major regrets.
Exactly. Aim for balance. Moderate savings, enough free time, reasonable commute, time with family. Balance increases your odds of being able to endure the plan long enough, even as you change.
And be willing to change the plan. No sunk costs.
Kahneman's philosophy again. I have no sunk costs. Be ruthless about abandoning goals or strategies set by a different person, your past self. The quicker you adapt, the less regret you'll have, and the faster you get back to compounding.
Okay, all these insights, unpredictability, change, psychology, they boil down to a simple truth. Nothing's free.
Right. Every benefit has a cost, even if it's hidden. There's always a price tag, often paid in worry, doubt, or uncertainty, not just dollars.
Like the GE example. CEO Jeff Immelt got hammered when the stock fell.
But his point was, every job looks easy when you're not the one doing it. The price he paid, the challenges he faced, were invisible to the critics.
And in investing, the price for long-term returns isn't just the money you invest.
It's the volatility, the fear, the doubt, the regret you feel during downturns. That's the cost of admission. The Dow's great long-term return came with terrifying drops along the way. Netflix, Monster Beverage, huge winners, but they spent like 95% of the time trading below their previous highs.
Wow, that's the price of those huge gains. And people try to avoid paying that price.
Through market timing, usually,
Yeah.
trying to get the gains without the pain, but they often end up paying double missing gains and incurring costs. Studies show investors underperform their own funds because they buy and sell at the wrong times.
It's crucial to see volatility as a fee, not a fine, isn't it?
Absolutely critical distinction. A fee is what you pay for a service, like good long-term returns. A fine is a punishment for doing something wrong. If you see downturns as a fine, you'll try to avoid them, probably fail, and get discouraged. If you see them as the fee, you're more likely to pay it willingly and stick around.
Which connects perfectly to the next point, you and me, recognizing that different people are playing different games.
This is so important. There's no single right price for an asset because investors have totally different goals and time horizons.
A day trader looking at Google stocks sees something completely different from someone saving for retirement 30 years away.
Exactly. And bubbles often happen when the mix of players shifts. Short-term momentum traders flood in, overwhelming the long-term value investors.
Like the dot-com bubble with day traders, or the housing bubble with flippers.
Precisely. They weren't playing a long-term valuation game. They were playing a short-term, pass-the-hot potato game.
And the danger is when you, maybe a long-term investor, get caught up in their game without realizing it.
That's the blind collision. You end up reacting to price movements driven by people with totally different objectives and timeframes than you. It also applies to spending. Don't let someone else's spending, who might be playing a show-off game or a deep-in-debt game, influence your own financial game.
So the key is, define your game.
Clearly, what's your time horizon? What are you actually trying to achieve? Write down your investment mission statement.
Like, I'm a passive investor, optimistic about long-term growth over 30 years.
Something like that. Then anything that doesn't align with your game daily market noise, next year's recession predictions, you can largely ignore it. You're not playing that game.
Okay, last big psychological insight, the seduction of pessimism.
Ah, yes. Why bad news always sounds smarter and gets more attention.
It really does, doesn't it?
Yeah.
Why is that, and why is it dangerous for long-term thinking?
It's dangerous because, statistically, optimism is the more rational bet over the long haul. The world does tend to get better, despite setbacks. But pessimism, it just feels more intelligent, more critical. It grabs our attention.
Like that Russian professor predicting the US breakup back in 2008. Front page news.
Totally. Compare that crazy pessimism to the actual mind-blowing recovery and growth of Japan after WWII. If you'd predicted that optimistic outcome back in 1945, people would have thought you were insane,
Yeah.
but it happened.
So why are we so drawn to the negative?
Part evolutionary instinct, threats, losses, grab attention more than opportunities, gains. Part media dynamics, bad news sells, affects everyone. A market dip is headline news, steady gains aren't.
And pessimists often just extrapolate current negative trends indefinitely.
Without accounting for adaptation, markets adjust, people innovate, problems get solved. Like the oil running out predictions before fracking changed everything. Pessimism often ignores our ability to adapt.
Plus, progress is slow, setbacks are fast.
Exactly. Decades of declining heart disease deaths save hundreds of thousands of lives, but it's a slow, quiet trend. A single terrorist attack is instant, dramatic news. Setbacks feel immediate. Progress feels gradual and is easily missed. Pessimism gets the spotlight.
Okay, wow. That's a lot of powerful psychology. Let's try to bring it all together now with some core takeaways.
All right, first, humility and forgiveness. Be humble when you succeed. Luck played a part. Be forgiving when you fail. Risk is real.
Less ego, more wealth. Suppress the urge to spend today for more options tomorrow. That gap is wealth.
Sleep at night. Manage money reasonably so you're comfortable, not just mathematically optimized. Sustainability matters.
Long time horizon. Focus on endurance. That's where compounding really takes off.
Be okay with imperfection. Lots will go wrong. Tails drive results. Judge the portfolio, not the individual parts.
Use money to buy control over your time. That's the ultimate dividend. Freedom.
Be nice, not flashy. Kindness and humility earn respect, not fancy stuff.
Just save. Save without a specific goal. That creates flexibility for surprises.
Remember, fees, not fines. Market volatility is the price of admission for returns. Pay the fee.
Worship room for error. That buffer is everything. It ensures survival and lets you stay in the game.
Avoid extremes in your plans. You'll change, so maintain flexibility. Balance promotes endurance.
Take strategic risks, like long-term investing, but be terrified of ruinous risks, like excessive debt.
Define your game. Know your goals and time frame and ignore the noise from people playing different games.
And finally, respect the mess. Smart people disagree. Mistakes happen. That's okay.
Okay, so time for confessions. How do we apply this stuff personally? And remembering, of course, this is just our approach, what works for us, not advice for everyone.
Right. For us, the number one goal has always been independence. Like Munger said, I just wanted to get independent. Not necessarily rich, but free. Control over our time is paramount.
And that means living below our means has been key. We've consciously tried to keep our lifestyle relatively stable, even as income grew over the years. Most raises just went straight into savings, into that independence fund.
Trying to stop that goalpost from moving, basically.
Exactly. And we make choices that look irrational on paper, like owning our house outright, no mortgage.
Financially, especially with low rates, that's often called a bad move. You could invest that equity.
Theoretically, yes, but the psychological benefit, the peace of mind, the feeling of independence from having no mortgage payment, for us, that outweighs the potential extra return. We sleep better.
We also keep a pretty high cash balance, right? Maybe 20% of assets outside the house.
Which again, flies in the face of conventional advice telling you to be fully invested. But for us, that cash is our buffer, our room for error, our oxygen of independence.
We never, ever want to be forced sellers of stocks in a downturn because we need cash for an emergency. That buffer lets us ride out the storms and stay invested for the long haul.
And our actual investing, dead simple, dollar cost average into low cost index funds, month after month, year after year.
We really believe the keys are a high savings rate, patience, and long-term optimism. Not trying to pick stocks or time the market.
We focus on what we can control, saving and patience. Because as we've discussed, outcomes are often driven by tails and luck anyway. Keep it simple, stay the course.
So wrapping up this whole deep dive, the big message is there's no single right answer for everyone. It's personal.
Deeply personal. Psychology matters just as much, if not more, than the math.
So here's a final thought for you to consider. In this world of slow progress, fast setbacks, and knowing your own desires will shift over time, what's the one financial principle you'll commit to above all others to make sure you can survive and thrive on your own terms?
We've learned that money is less about spreadsheets and more about psychology, about patience, humility, and the choices we make every day. The real secret to wealth isn't luck or genius, but discipline and perspective. Thank you for joining us on this journey through the psychology of money. If you enjoyed this episode, don't forget to subscribe, like, and share this podcast with your friends and family. Your support helps us bring you more powerful insights every week. Until next time, remember, how you think about money is just as important as how you earn it.